7, chapter 23. Okay, so for chapter 23, we are looking at variable costing versus absorption costing. We will look at the segment reporting. We are going to look at residual income and how to measure it. And some other details later on at the bottom. So let's go one by one and see what's going on in your book, and if I can explain it a little bit more. Okay, so what is absorption costing? It's also known as full costing, a costing method where inventory absorbs direct cost and variable and fixed factory overhead. Absorption costing, technically, it's normal way of calculating cost of production and providing financial reporting to insiders or outsiders. Outsiders are creditors, potential investors, current investors. It's a regular way of providing financial statements like income statement and balance sheet. However, we have other way to talk about costing and providing financial statements, which is variable costing. So in absorption costing, the product cost includes direct material, direct labor, and overhead. The overhead is just the combined overhead, which is partially variable overhead and fixed overhead. So remember, in absorption costing, direct material is variable, direct labor is variable, variable manufacturing overhead is also variable, and we add to that obviously the fixed part of the overhead and combine them, and we tell them, okay, this is the product cost, and whatever we sell above product cost, that will be our revenue from the sales. So the cost of goods sold, if it's sold, it will be included like direct material, direct labor, variable overhead, and fixed overhead. In the period cost, we have two types of expenses as a period cost. It is selling expenses and general administrative expenses. Some of those selling expenses and general administrative expenses can be variable. Some of them might be fixed. And that's normal period cost. So this is a normal way of generating financial information, income statement, balance sheet, the way that we learned so far in accounting. So this is a normal way. However, we have also a variable costing, which is a costing method where inventory absorbs direct cost and variable factory overhead. The income statement identifies the contribution margin. What is contribution margin? If you remember, contribution margin, it's a dollar amount that it's left over that we can use that to pay for fixed expenses. So in the variable costing, we have product cost, which includes direct material, variable cost, direct labor, again, variable cost, and variable manufacturing overhead, which is variable cost. So as you see, the product cost is just the variable cost. But here under absorption costing, the product cost was variable cost plus the fixed part of the overhead, which is normal, right? You say overhead is overhead, doesn't matter if it's variable or fixed. But under variable costing, we just want everything to be variable, which is direct material is variable, direct labor is variable, And why direct material or labor is variable? Because if you don't produce anything, you're not going to use any material or labor. So that's why direct material and direct labor is variable. But what is in the period cost? In the period cost, under variable costing, you expense complete fixed manufacturing overhead in that period cost. It will be expensed immediately, all of it. And variable selling administrative expenses and fixed selling administrative expenses. So under variable costing, you have a contribution margin, which is revenue minus variable cost of production, gives you contribution margin. Okay. So let's see if there is any example here. Okay, here is an example. Assume that the company produces 10,000 units of a product, okay, and per unit cost is $2 for direct material, $3 for direct labor, $4 for variable factory overhead. So 2 plus 3 plus 4. In addition, fixed factory overhead amount is $10,000. The product cost under absorption costing will be $10. Where is that coming from? Which is $2 from material, $3 for labor, and $4 for factory overhead. Okay, so far $9, and $1 of allocated fixed factory overhead, because we have $10,000 fixed cost divided by 10,000 units of production ends up to be $1 for fixed cost. So if you add them up, that will be total $10. Under variable costing, the product cost is limited to the variable production cost only, which is $9. Now consider a management decision. Assume that company is approached to sell one additional unit at $9.50. Do you think management will accept that? This sale will not result in any added selling administrative costs or otherwise impact sales of other units. So based on absorption costing method, the additional unit appears to produce a loss of 50 cents, because if you think based on absorption, you say, no way, my cost is $10. Why should I sell it for $9.50 if I have such an offer? And it appears that the correct decision is to not make the sale, right? However, under variable costing suggests that a profit of 50 cents will come up if you sell it for $9.50, because your variable cost of production is $9. And the information appears to support the decision to make the sale. Management may well decide to sell the additional unit at $9.50 and produce an additional 50 cents for the bottom line, which is extra income, right? Remember, no other cost will be generated by accepting this proposed transaction. If management was limited to absorption costing information, this opportunity would likely have been forgotten. So it's a good thing for management, not for outsiders, not for reporting to outside, but just for management purpose. It's a good idea to understand that we have $9 variable costing, and we will have 50 cents profit if we sell it under this proposed $9.50. This is an offer that came from somewhere, let's say another region, another country, say, hey, I'm going to buy so many units from you for $9.50. Will you sell it? And management might say, okay, normally we don't sell it for that price, but this is one-time offer of good opportunity to make a good amount of extra income, at this moment. Why not? Let's take it. Since we are not working over our capacity, we are working in the capacity range of our production. So we can do it without any extra cost from anywhere. So why not? But under absorption costing, if you just know, you say, oh, my my cost is $10 under absorption costing, why should I sell it for $9.50? But if you know as a manager that your variable costing is $9, then $9.50 will be a good idea. Okay, so let's keep going a little bit down. Okay, let's look at this airline idea. As time nears for scheduled departure, unsold seats represent lost revenue opportunities, right? If there is any seat that it's still unsold, that's a lost opportunity for airline. So the variable cost of adding one more passenger to an unfilled seat is quite negligible. And almost any amount of revenue that can be generated has a positive contribution to profit. Last moment, let's say 20 minutes before flight, you have 10 seats available, unsold. Nobody gonna use it. So in the last moment, that extra 10 seats available, if it's sold, it will be a good positive contribution to the profit of the company, right? An automobile manufacturer may have a contract with union labor requiring employees to be paid even when the production line is silent. As a result, the company may conclude that they are better off building cars at a loss to avoid an even larger loss that would result if production ceased. So sometimes they have to pay for those employees in the car manufacturing factory, even because they are under union. So even if there is no demand for it. So in that case, at least they're gonna use those available employees' time and do the production and then sell the car, at least for the cost, and to pay for the employee union paychecks that they have to pay no matter what. Okay, so you can read this part. And also you can read this part. It's just talking more about this variable costing and the absorption costing. So let's look at this income statement, see what's going on. Much of the discussion focused on per unit cost assignments. In addition, the examples assume that selling, general, and administrative costs were not impacted by specific actions. Okay, so far so good. It is now time to consider aggregated financial data. The following income statement present for the Naples company. On the left, it is income statement, yes, using absorption costing method. On the right is the same information using variable costing. For now, assume that the Naples sells all its produces, resulting in no beginning or ending inventories. That's an important assumption, okay? This is very important. So right now, assume that they're gonna sell all the products without any beginning or ending inventory. So everything produced is everything sold. Okay, keep that in mind. Here is the absorption costing. You have the sales revenue minus cost of goods sold, provides you $300,000 gross profit. And then you deduct your operating expenses, which is period cost, selling and administrative expenses. Some of it might be variable, some of it might be fixed. And then you end up by having an income of $87,500. So far, so good. Under variable costing, you have, again, the same sales amount. You deduct the variable product cost, just the variable, which is direct material, direct labor, and variable overhead. 300,000, it's different than 450 here, right? Where is the 150 going? The 150 is the factory overhead, factory fixed overhead, which goes below contribution margin and will be expensed, all of it in the same period in this variable costing income statement. So as you see, we have variable manufacturing margin of 450, very important. And then less variable selling and administrative expense gives us the contribution margin of 337. Below contribution margin, they are all fixed expenses, including factory fixed overhead and fixed selling and administrative. So what is contribution margin? One more time. Contribution margin, it's a dollar amount after deducting all variables from sales available to pay for fixed expenses and have some profit left. However, if you see here, 87.5 is exactly 87.5 on the other side. That means if a company produce whatever they produce and sell all of it and nothing is left, then the income in the income statement, net income, will be exactly same either under absorption costing or under variable costing. Remember, variable costing is for internal use. Okay, you don't give this variable costing income statement to anyone, but all you want to know that what is your contribution margin ratio, what type of fixed expenses you have, and that contribution margin ratio is very important for management because they know if they have any potential of sell of a product to someone, even with lower price, but still is creating higher contribution margin, then it will be good because that higher contribution margin will help to pay all those fixed expenses and increase the income. But in this scenario, because we produced whatever we did and we sold all of it, so the result, as you see, is same. However, let's see in this example. It says the following income statement are identical to those previously we discussed, except sales and variable expenses are reduced by 10%. Assume that units relating to the 10% reduction were nevertheless manufactured. What is the effect of this inventory buildup? Income is higher under absorption costing by $15,000. This is consistent with the general rule of thumb. Increasing inventory causes income to be higher under absorption costing than under variable costing and vice versa. So let's talk about this a little bit here. So if you see under regular income statement, which is absorption costing, we have sales of 675 and we have cost of goods sold of 405. We have gross profit of $270,000. So we sold, that's your cost of goods sold, that's your gross profit. And then we have variable selling administrative of whatever it is, plus fixed of 100,000, and that gives us $68,750. Okay, so let's look at this one more time, and I want you to learn this because you might get a test question in our course, or you might get a test question in a CPA exam in future. So it's a good moment for to learn this and remember what I'm telling you. So under absorption costing, as you see here, we sold 90% of whatever we produced, and the 10% of production was not sold. Okay, one more time. From the complete production, 90% was sold, 10% was not sold. Therefore, the sales goes down by 10%, cost of goods sold goes down by 10% compared to here. You see, 750 minus 10% that is not sold, cost of goods sold minus 10%, which is not sold. So therefore, the sales is less by 10%, cost of goods sold is less by 10%, and gross profit is less by 10%. And therefore, the variable selling and administrative is also less by 10%. As you see here, that's the variable sales and administrative, which is now less by 10%. And therefore, the income is $68,750. So in this example, we produced more and we sold less. So under variable costing, if you produce more and you sell less, then you will have expense only the variable cost, right? But you will expense the complete fixed overhead. So all fixed expenses under variable costing will be expensed immediately in that time period. That means your inventory left over is just based on variable expenses, because all of your fixed overhead is already expensed right here, as you see, just like the regular that you sold all of your product, right? Here you sold all your production, your fixed overhead is expensed. Here you sold just 90% of your production, but still all your fixed expenses are sold, right? And because of this situation, look at the net income. The variable, under variable costing, if you produce more and you sell less, your income is less, as you see, and your balance sheet shows less inventory value. Why? Because in your balance sheet, under variable costing, you have only inventory left over, which includes variable direct material, direct labor, and variable overhead. That's it. No fixed overhead, because fixed overhead is already expensed. So your the value of your balance sheet is also less. So let's focus one more time, listen exactly what I'm saying, and remember just this sentence. Under variable costing, if we produce more and we sell less, the income is less, the balance sheet is less. One more time, under variable costing, if we produce more and we sell less, our income is less, our balance sheet asset inventory value is less. As long as you remember this, the opposite is true. Okay? And the opposite is this one. Here, this is another way your book is trying to explain, but this is the way I tell you to remember. So under variable costing, if you produce more, you sell less. Your income is less, your balance sheet is less. One more time. Under variable costing, if you produce more, you sell less. Your income is less, your balance sheet is less. This is something that's so useful to take care of multiple choice questions, either in this class or in a CPA examination. So here is a picture. Let's see how it goes here. So absorption, costing, cost allocation. So here is the ending inventory. Under absorption costing, direct materials goes in the ending inventory. Yes. Direct labor goes in the ending inventory. Correct. Variable manufacturing overhead goes in the ending inventory. Yes, it's correct. And fixed manufacturing overhead, a portion of it goes also in the ending inventory. So under absorption costing, you see that below at the bottom, we have blue color fixed overhead. We have green color variable overhead. We have red color direct labor, and we have direct material. So that combined, that will be your ending inventory, right? So under absorption costing, if you produce more and you sell less, your ending inventory is bigger, as you see here. But under variable costing, if you produce more and you sell less, then your ending inventory is smaller. As you see here, the ending inventory under variable costing is just direct material, direct labor, and variable overhead. So one more time, let's repeat whatever I just said. Under variable costing, if you produce more and you sell less, the income is less and the balance sheet is less. And as you see here in the balance sheet, your ending inventory is less than absorption costing. Simple as that, okay? But why variable costing is so useful? Because management need to use variable costing to understand the contribution margin ratio and to make good management decisions that you cannot use absorption costing, income statement, and gross profit ratio to have such a useful management decision at the time that you need to have a quick, useful decision. When, let's say, you get an offer from another country, another region to sell a product for a specific price, which is normally way below your selling price, but you just want to know as a manager, what should I do? Should I sell it or not? And that moment, it's a very important moment. So many times in a business, you make one decision, and that one decision can either make your company take your company to the next level, or take your company to the bottom and make it disappear. So, important management decision. Okay, what is segment reporting? Segment is a business unit for which separate financial information is evaluated by an operating decision maker who allocates resources and judge the performance of that unit. So it's a unit of the business. It's a separate unit of a business, and you call it segment. Okay, so it's important. It's in the internal reporting, a segment might be a region, might be a territory, might be a division, might be a product category, or might be a department, or any other type of classification you believe it's a good classification as a segment. A segment, as judged by upper management, might be made up sub-segments that are in turn judged by middle management. So you have a segment that is judged by the management at the top, but every segment might have few sub-segments that those sub-segments are under control by middle managers. The segmentation of entity is highly subjective process, obviously, yes. And the goal is to divide or so-called allocate overall performance outcome to the various moving parts that makes up the entire entity. In other words, segment data should indicate that each part of the entity is contributing to the overall business outcome. So let's keep going down, look at the case study, see if I can explain something here. Here is Zen Computers, a diversified company with two primary divisions, computer hardware and system support. So we have two divisions. The hardware unit focuses on personal computers and personal digital entertainment devices. Below our partial contribution income statement to Zen, review the statement carefully, taking into consideration the various notes within the illustration. Okay, so we have to spend some time here to see what's going on. So this is the division reporting for hardware contribution income statement. Okay, got it. Net sales division is 18,000, but the division, the hardware division has PC and personal digital devices. So we have sales of 12,000 for computers, personal digital devices 6,000, and that's total $18,000. We have variable expenses, product cost 6,600 total. We have variable selling administrative cost, 1,800. Total variable cost is 8,400, and the contribution margin for this division is 9,600. And as you see, every division has a subcategory, and PCs they have also positive contribution margin, and also personal digital devices, they have also positive contribution margin. And what is the variable product cost here? Do you remember variable product cost is direct material, direct labor, and variable manufacturing overhead. That's what variable product cost is. So looks like both of them have positive contribution margin, which is good. And then we have controllable fixed cost, which is $2,000 controllable fixed cost directly traceable to PC, and $800 directly traceable to PDE, and $400 is like non-traceable. So combined, controllable fixed cost ends up to be $3,200 for the division. So the controllable margin will be contribution margin minus controllable fixed cost. It is controllable contribution margin of $6,400. And obviously, again, here you see that controllable contribution margin for PC is again positive. Controllable contribution margin for PDE is also positive. So far, so good, very good news. And this one obviously is negative because we don't have anything in a form of revenue for this. It's just general. Okay, so far, so good. But we have some uncontrollable fixed costs. Those are by management, but incurred by segment, like property tax, like depreciation of equipment, those type of things. So those are uncontrollable fixed costs. That means gonna happen no matter what. Make sense? That means no matter what you do, this $500 for PCs, depreciation, equipment, or whatever, property tax, and PDE, that will happen no matter what. And this is 200 general for the whole factory. So those combined will be $1,000, and it is uncontrollable fixed cost. So controllable margin, contribution margin minus uncontrollable fixed cost gives us a segment margin. And as you see, again, is positive on each side, and total is 5,400. Okay. And we talked about it. Let's see what's going on in here. And okay, this is two division of this company, which is hardware, which we just looked at it. That was hardware, including subcategory of PC and PDE. And also this is the second hardware, which is system support, which is $11,000 net sales just from system support. And this $5,400 segment margin came from here, as you see. And we have system support, which is $1,500 segment margin. Very good. And we have total segment margin of $6,900 that coming from these two areas. General corporate cost is about $1,700, which will be deducted from the segment margin. And finally, we get to the net income. So as you see, this is in reporting for the inside of the company. And you see the two divisions, and each division might have two subdivision like PC and PDE in this category. And then there are some general corporate cost that is not traceable to any of those divisions. That means this corporate cost will happen no matter what. So corporate cost minus segment margin gives us a net income. And that's the net income that normally you see in an income statement, but you never see something like this because this belongs to inside managers. So how about external segment reporting? In an external segment reporting, you just see regular income statement, so-called, which is like here, let's say it says net sales for year 2015 and 2014 and 2013. Electrical industrial products, sales, galvanizing services for this company, let's say, you see different type of services. So total revenue sales from 2015 is higher than 2014, but 2013 was much better than either for 2014 and 15. So segment reporting income, electrical and industrial product had operating income of $16,838 and $15,000 for that happens in 2014 and $23,000 in 2013. This is a segment operating income, A. Segment operating income consists of net sales less cost of sales. Specifically, here cost of sales, that means sometimes you have sales minus cost of goods sold if you are selling something material, tangible. If you are just having sales, but you are a service type of company, then you call it cost of sales. Cost of sales is technically same thing as cost of goods sold, but not tangible. So, specifically identifiable selling, general and administrative expenses and other income and expenses items that are specifically identifiable to a segment. So A shows operating income after deducting, cost of goods sold minus operating expenses like selling and general administrative expenses. So that's operating income from segment. So here is segment operating income is $16,838. 2014 was 15, and 23,000 was for 2013. So, okay, we got that one. Reconciliation of segment income to corporate income. So general corporate expenses are 7,700, which that is general corporate expenses consist of selling and general administrative expenses that are not specifically identifiable to a segment. So that's why we calculate them and consider them separately, because operating income is good for each for the segment, but we want to know what is that is now traceable to a specific segment. So here is general operating expenses, general corporate expenses, I mean, some interest expense. Again, those are other expenses that happens. Normal, these type of things are, we call it other expenses, okay? Those are not traceable. And other income or expenses, again, 76. And those are total total expenses come from general matters like corporate general expenses, interest expense that belongs to the whole business, and other expenses that again belongs to the whole business. So that's, in this case, is $9,431, but operating income for the segment, each is 16,838. That's why it gives you an income before tax of 7,404. Okay, so one more time from top to bottom. Here is your total net sales. Okay, net sales. And the net sales minus traceable segment expenses gives you operating income. So expenses are not showing here, but we just got the operating income. Remember, in a regular income statement, we have sales minus cost of goods sold gives you gross profit. Gross profit minus operating expenses gives you operating income. So here is the sales. As you see, cost of goods sold and operating expenses are kind of not in this area showing right now, but you have the operating income, right? So sales minus cost of goods sold minus general selling administrative related to the segment gives you operating income. And I have the operating income. Operating income minus other expenses gives you net income before tax, and net income before tax minus tax gives you net income, right? And so in the balance sheet, we have also total asset of, let's say, 79,000. Also, we have, looks like galvanizing services type of assets for the 5,000, whatever it might be. And corporate assets, it's 4,169, and that's what it shows total asset for the company. Okay, so we have some data here. This is the income statement area, income before tax, and here we have balance sheet area for the asset. Okay, let's see what else is coming here. We need to, okay, what is residual income? It's an internal assessment technique that adjusts income for a presumed cost of capital or other threshold for rate of return. The residual income formula is operating income, whatever it might be, from the daily business operation profit minus whatever operating asset we have multiplied by cost of capital. What is cost of capital? Cost of capital is a cost that happens to any business when they raise capital to start and run and continue their business. There is two ways to raise a capital for a business. You can either issue stock, which is equity financing, or you can issue bonds or borrowing, and that's debt financing. So no matter what you do, if you issue stock, there are some costs involved, let's say paying dividends, right, to your shareholders. If you borrow money, again, there is some cost, which is paying interest. The difference is that interest is mandatory to be paid. Interest expense is mandatory. You have to pay. However, dividend is not mandatory. So you might be able to skip dividend for a year or two, pay no dividend. Let's say, for example, I believe Amazon is not paying any dividend to its shareholders, at least up to this moment. And the reason they are not paying dividend, because they have the option to not pay. And they think that if they don't pay dividend and put that money in investment in Amazon, and make more warehouses, more distribution centers, or hiring more employees, or buying better equipment, it will create better results for the investors. And in most cases, that's true, because as you've seen, Amazon was less expensive before, but now the stock price keeps going up and up and up. And the reason is because Amazon is constantly investing in the business and creating more income, and that will by itself generates higher stock price. However, paying interest because of borrowing, it is mandatory. You have to pay. So there is a sweet spot, how much you want to borrow and how much you want to do equity financing. So that sweet spot ends up to have a specific lowest possible cost of capital for the business. The other name of cost of capital is WACC. We call it WACC, weighted average cost of capital, weighted average cost of capital, WACC. You can also Google that to learn a little bit more about it. And that's more into finance type of major. And you will learn in accounting, obviously, a little bit of that, but you will be very, very much more involved with calculation of WACC and finding that sweet spot of how much borrowing or how much equity financing you need to do. And that's more into finance major. Okay, so what is residual income? The residual income is technically any profit from operating income in excess of the cost of having all those operating assets, right? When you buy operating assets, that has a cost. You need to pay some interest, you have to pay some dividend. And when you have those assets now into your operation, you want to create a little bit more income than the actual cost of capital. So any income above actual cost of capital, which it will be operating, it will be residual income. Any operating income above cost of capital will become residual income. Residual income, that means extra income. Any income that the company is creating above its cost of capital for the operating assets. So it's operating assets times the ratio of cost of capital. That's minimum that the company needs to generate. Anything above that will become residual income. So here we have a case study, which is good. So here is, let's see. Okay, we have two segments in the same business, looks like, right? Same business, two segments. One of them is electrical segment. The other one is galvanizing segment. The operating income from electrical division is 7.2 million. The operating income from galvanizing is 9.5 million. And assume the cost of capital, WACC, WACC, weighted average cost of capital. There's another name for it. We call it residual, minimum required rate of return or hurdle rate. Minimum required rate of return, hurdle rate, or weighted average cost of capital. So the cost of capital for this company, we assume, is about 10%. And 10% minimum you need to generate just to justify $79 million of operating asset investment, right? So 79 million times 10% is 7.9 million. And 45 million operating assets for galvanizing division times 10% minimum required rate of return, and that gives you 4.5 million. So it looks like in electrical, we don't have residual income. We are technically in the deficit in regards to residual income. We don't create enough operating income to justify that 10% cost of capital. We are in deficit. However, in galvanizing, we are doing perfectly fine. And we are above the minimum required rate of return. for the cost of capital, and we have about $5 million residual income. Okay, so far so good. Let's see what else we have here. Okay, so keep that in mind. You can read this yourself later on, obviously, but let's move on to the next, see if I can explain a little bit more. Let's see. Okay, so you got the idea of residual income and two segments. One of them might be in a deficit situation, doesn't have enough income for residual income to cover the minimum required rate of return and having a residual income. But the other segment, as you were looking at, doing much better. Now there is some cost in a business that happens no matter what. So the cost of services that a department is directly providing to productive departments needs to be so-called applied to other departments. So on the direct method, the allocation process of the cost is of service department to productive department is like a direct method. We directly apply to it. There is also a step method, then another method. So let's look at a visual example here. That's a good one. So here we have two service departments. Every department obviously has some cost, right? Service department is not in charge of, generating income or something. They are just in charge of providing services to the whole company, right? So they have some cost. Okay, but who's going to take those costs? Who's going to take responsibility of those costs? How do you want to allocate these costs to the productive departments where they generate income? And we're constantly saying, oh, we make this much money, right? So these service departments, directly you can, using direct method, okay? Using direct method. Directly, you can apply the cost to the productive department based on some type of allocation. Depends what it is. So let's say cafeteria. Cafeteria, you might so-called apply the cost or allocate the cost because of how many employees those departments have. So if department one, let's say printing, has, let's see, 5 out of 20 employees, then five employees out of total 20 employees, that will be a ratio. And based on that ratio, we apply $150,000 to printing. So here we deduct the $600,000 to make it 0, and we apply 5 out of 20 to printing. But for binding, we have 15 out of 20 employees. So we have more employees in here. Therefore, binding, we get $450,000 out of that 600,000. So that's how you allocate directly to every productive department. That's why you call it direct method. And the other one is maintenance. Okay, maintenance, you might go with the square footage or something, I believe. Let's see. Ratio printing machine to total productive department. Oh, it's not based on square footage. It's based on printing machines, how many machines they have. Okay, that's fine. So because it's maintenance, that makes sense, right? So maintenance, we go with how many machines they have. That's fine, much better. So let's say we have totally 40 machines, but 30 of those machines are in the printing and just 10 of those machines are in binding. So 30 out of 40 machines, that gives you a ratio times 900,000, $675,000 will be applied to printing. But in the binding, we have just 10 machines out of 40 total machines. So 10 out of 40 times 900,000, that gives you 225,000 allocation of cost for the maintenance service department to binding. And then you can just add them up. So department cost for printing is $3.7 million. Cafeteria allocation is $150. Maintenance allocation is $675. Total cost after allocation is $4.5 million. For binding, the same thing, it's like 3.175 million. So this is the direct method, okay? But we have also step method. You have to choose which one you want to do, because there are some differences. You might say, oh, this way, it's not fair. Let's do it step method. Okay, in step method, which sometimes you can justify it, you can say, okay, wait a moment. The maintenance department is also drinking coffee, right? It's not, breakfast and coffee for printing and binding. The coffee is also for maintenance too. So how about the maintenance needs to, take some responsibility of that cafeteria cost. So in that case, you go step by step. So in step one, you apply the cafeteria, which provides service to everyone, proportional. So here, $600,000 of cafeteria cost will go, let's say here. We have 10 people in maintenance, we have 5 people in printing, and 15 people in binding. So that gives us total of 30. So 10 out of 30 in the maintenance, maintenance gets $200,000 of cost of cafeteria. And then printing gets only 5 out of 30, and that's 100,000. And binding gets 15 out of 30, and that's 300,000. So that's how you allocate on step one under step method to every single department that has an employee. But maintenance just provide maintenance to machines which are in printing and binding. So now the maintenance has total of 900,000 plus 200,000, that's 1.1 million. That $1.1 million times 30 machines out of 40 machines, that gives 825,000 to printing, and 1.1 million times 10 out of 40 machines gives 275,000 to binding. And then you can compare, you see the printing now, the total cost ends up to be 5.625, which before was 5.525. So it's $100,000 more cost into printing department, and binding under step method gets 3,075,000. Before was 3,175,000. So now binding gets less expenses, less cost. So printing will, take more, and depends on the management, the way they think, but direct method is the way it is. Looks like step method is a little bit more sophisticated, I believe. Okay. Let's see. This is something that it's good to read. This is not a single correct. There is not a single correct method for slicing and dicing a company's overall results into utilized information sets. So there is always different ways to do it, right? And depends on your how sophisticated your information system is, your computer system, and how the data will be collected and used in a company. Some companies, they have very good sophisticated data collection. Some companies don't. But in general, data analysis, it is a very important subject nowadays for businesses, because by doing data analysis, they can understand so many good, important details about the operation of the business and future decision making, that it can change the outcome in future. So let's say here we have a case study that it says, consider the company data set revealing that $24 million was spent on compensation. Okay, of that amount, 16 million was spent on factory labor and so forth. So you see here, the total compensation was $24 million. However, in the factory, compensation for employees was about 16 million, in sales 3.7 million, general administrative is 1.5 million, and general 1.5 million, and administrative 3.2 million. So total compensation was $24 million. And then you want to see, okay, where this $24,000 exactly is going to, and you see, $15 million goes just to salaries and wages, but you have company pays for health insurance, that's $1.5 million, unemployment taxes, $359,000, that's unemployment insurance tax. They call it FUTA and SUTA, federal unemployment and state unemployment. That's up to first $7,000 of income of every employee, that they charge about 6% for FUTA and SUTA combined. FICA, it's again half of the Social Security and Medicare. Social Security, half of it is 6.2%. Medicare, half of it is 1.45%. So it's about 7.3%, I believe, combined, 6.2 plus 1.45, right? You do the math. And that will be the FICA tax for every dollar of income employees have. Just so you know, the Social Security tax is has a threshold up to certain limit, like $140,000 or so. There is no more Social Security tax after that, but Medicare, yes, there is tax for every dollar of income, no matter what. So FICA, it's a big also part of the expenses for the compensation. A retirement contribution for matching with employees, whatever they put in the retirement, 401k, workers' compensation insurance for employees, bonuses, and vacation accruals, sick leave accruals. Those are also liabilities that the company owes to employees until they take that vacation. And tuition and training, about 119. That's total comes $24 million. So as a manager, you want to look at those details and see if something is fishy or smells bad or it's too much, or you can adjust something, right? And then you say, okay, let me go a little bit deeper. And now, instead of just looking the whole details, let me look at the every category of the business departments. So in the factory, I have like that much salaries and that much expenses, and let's say bonus is $25,000. For $10 million of salary, we have $25,000 of bonus. Okay. Oh, workers' comp is very expensive here because it's in the factory and there's higher possibility of getting injured. So that's why workers' comp is higher. And sick leave and vacation leave, got it. Okay. Now you go to sales, you say, let's say, you look in the data and see if something is fishy or not. Let's say bonuses is $575,000 bonus for sales. Okay, so it looks like you don't have that much bonus for factory, but you have big bonus for sales. In general office, in general expenses departments, you have $1 million of salaries, and let's say bonus is like 50,000. Okay, and administrative is $1.2 million of salaries, and the bonus is wait a moment. Look at this bonus. You see how big this is? Compared to 1.2 million, we have such a big, the bonus is more than the salaries. Really? You see? As a manager, it's your job to look at these issues and find where you can put some control on those expenses and bring more income for your company at the end, at the bottom line, as a form of net income. So yes, those are the totals, but those 4 areas needs to be investigated. And I can see right now, there's a big issue here in regards to bonus for administrative. And I believe the bonus is very huge here because at administrative, those are CEOs, CFOs at the top, and those top management, they get high bonuses. That's why they have such a big bonus right there. And again, you can have a dashboard to look at the overall situation in visual type of reference, and that will be also useful for managers. And here is the big data that I was talking about, okay? Which is nowadays data analysis. It's a very important subject in business, and you definitely, I suggest, take classes for data analysis.